In this video, we want to talk about abnormal profits. There are two types of profit we can distinguish, abnormal and normal profit. Abnormal profit is sometimes called excess profits. Now, normal profits are those profits that are necessary to maintain a company in production, to maintain a company in existence. Normal profits is what it must make in order to keep it going. Abnormal profits are profits over and above normal profits. So abnormal or excess profits are profits in excess of that necessary to keep the firm in the industry. So it's any profit over and above that necessary to keep the business working. To stay in the industry, the firm must cover all costs, including its opportunity cost. Now, opportunity cost is defined as the cost of the next best alternative foregone. It's the cost of the next best alternative that's given up. So when people go into business, they're giving up their investment resources, they're giving up those, and those could have been used for some other purpose. So the cost of going into the business is what they're not doing. It's what they didn't invest in. It's the alternative they didn't go into. So, in other words, costs include opportunity costs. Now, normally we think of costs as the cost of raw materials, the cost of labor, the cost of equipment, and so on. And these costs can be added up, counted up in an accountancy term. In accountancy terms, the accountants can add up the costs and work out the revenue and subtract the costs from the revenues to generate profits or losses. But in economics, economists include the opportunity cost as a cost. In other words, we have to estimate what would have happened to the investment in the business had it not gone into the business. Had the investors put the money into a different project, then the return on that other project must be allowed for, because that's what they gave up. So, as I said, the opportunity cost is the cost of the next best alternative foregone, the next best alternative given up. Let's take an example to illustrate opportunity cost. If a person sets up a business, let's say with £1,000, and in the first year of trading has revenue of £600 and a cost of £550. Just pretend, just say this is our example. So the person sets up a business with £1,000, trades for a year and has a revenue of £600 at the end of the year and a cost of £550. Now assume that the next best alternative or the next best opportunity for that person, other than going into business, is to put the £1,000 into a time deposit account in the bank, and let's say, for ease of calculation, let's say the person would have got 10% per annum on that account. Now, what we need to do is to work out the accounts with this information in mind. So the accountant for this business would look, or the accounts would look as follows. The accountant would work out the following. The accountant would say, well, the revenue is 600, the costs are 550, subtract the 550 from the 600, giving a profit of 50. Seems reasonable. But that figure does not take into account the £1,000 which was invested, which could have been put into the bank and would have yielded 10%. In other words, the person giving up £100 immediately, 10% of the 1,000. That's what the person would have got had he or she put the money into the bank. So there's £100 straight away not accounted for. Let's look at the accounts again, this time taking the £1,000 into account. We have the same information, but now if we go down to our accounts at the bottom, we can see here that the revenue is 600, like before. The costs, the cost of the raw materials, labour and so on, 550. And the opportunity cost, what could have happened, which was given up, which is the £100. The person could have put the £1,000 into the bank and got 10%. So they're giving up that £100. In other words, the total cost is 650, not 550. Which means this business is losing £50. In other words, it shouldn't be in this business. It's costing the business money to be in business. It's costing the company money to be in business. Let's go back for a second. You see, that's what we think normally. We think revenue minus costs equals profits. And that's what we would deal with in terms of accountancy. The economist sees it differently. The economist sees the total cost as the cost of operations plus the opportunity cost. So in this case it's minus 50. We have to allow for what would have happened had the money not gone into the business. In this case, the owner should not have started the business, since he or she would have received more by placing the capital in the time deposit. Putting the money into the time deposit would have given £100. Going into business and working has only given £50. So clearly, they should have not have gone into business, should have put the money into the bank. When a firm covers all costs, including opportunity cost, we say the firm is breaking even. So if the firm cover all costs exactly, including opportunity cost, that firm is breaking even, which is different from our work in other modules and in other videos when we talk about break even. This is the economics perspective of breaking even. It has a different definition of costs. This time it includes the opportunity cost. Now, any revenue over and above total costs in an economic sense, total costs being the explicit costs, the costs of raw materials, labour, capital and land and so on, all the bits and pieces that go to make a business, plus what we sometimes call the implicit costs, or if you like, the opportunity costs. So when we add those two together, we get the total cost. Now, any revenue over and above total cost, as defined like that, is abnormal profit. So once total costs are covered, any revenue over and above total cost is abnormal profit. And that's our definition of abnormal profit. It's important we come to terms with this concept. It'll crop up again in other videos and it'll crop up right throughout different modules. So it's important that we just come to terms with it. There will be other videos on the topic elsewhere. But that's all I'm going to deal with in this situation, in this class. So just leave it at that and say thank you for watching.